Today I'm joined with Claire Smith, Head of Private Assets Sales, and Eric Greer, Manager of Private Asset Sales at Schroders Capital. Thank you both for coming and welcome.
Thanks, Brad.
Thank you.
So I've got a bit of a personal question off the bat. What was the first investment you've ever made and how old were you?
Maybe I'll go first because I'm the oldest one. So when I was in uni, I've got a sister who's 10 years older than me. I've got a bunch of older siblings, and my dad gave her $10,000, which at the time was helped to get a deposit for a house. So being very fair, he gave all of us kids 10 grand, and we sat down and went through the AFR and picked a few shares to put it in.
Oh, nice.
So I put money in BHP, CBA, Telstra, and Fosters, which we decided were good sort of, buy and hold shares.
Yeah.
I've since sold the Fosters and the Telstra, but I'm still holding the BHP and the CBA. So
that would have done well.
Good long-term
investment.
Yeah. Good long-term investment. Eric?
I think my investment wasn't as good a story. It was when I was 18, I got a tip from a friend to get into this stock Novagen. Apparently they were going to cure cancer. So really exciting stuff. I think I put $500 in. And I remember telling my mum, and she was really excited about the fact that, I was taking initiative and investing and all this stuff. And then probably about a year later, I had my mum call me up, super excited that Novagen had just gone 10x and how exciting it was. I was like, this is great. Log into my share trading account and I'm down about $50 from the 500. And it turns out there's another company called Novagen on the New York Stock Exchange that went 10x and it wasn't mine.
Oh.
So the one that I had on the ASX just moved sideways. I think they ended up getting acquired and delisting. And I think I got out at like $430. So not the greatest start to my investing life. Yeah.
Very nice. Awesome. Claire, I'm going to start a question with you. Why should someone invest in private equity instead of public equity?
Yeah, it's a good question and something we've been talking a lot with investors about over the past few years, because obviously private equity is now evolved and there's fund structures that are much more accessible to everyday investors. I'd say it's not an either-or question though. We think obviously listed equity still plays an important part in people's portfolios. I think a lot of people like to have Aussie equities because you get a bit of a home hedge bias, I'd say, franking credits, all those sorts of things. But particularly what private equity can offer is important diversification away from listed markets. So I think, if you look at, say, a sector like healthcare, we have quite a large healthcare holding in our fund. And if you look at the major listed markets, there's only about 2,500 listed healthcare companies in the major OECD markets. But you look at, say, privately held healthcare companies, and there's about 145,000. So just much bigger universe to choose from. A while ago, there was a take private for Ramsay Healthcare. If that happened, your Aussie equities exposure is going to be very underweight a sector like healthcare, where you've got those more defensive characteristics. But it generally just provides, as I said, that sort of important diversification. You are somewhat trading off liquidity, though. So that's where public equities can still play a part in portfolios. And particularly this year, listed markets have rallied. So that's why you probably still want to keep your toe in listed markets. It can provide more volatility on the upside as well as the downside, but private equity provides a diversifier away from some of that volatility, and particularly access to other sectors and companies of different sizes that you can't access through listed markets.
Yeah, which leads me to my next question. Eric, how does private equity fit into an investment portfolio?
Yeah, sure. So I guess the main point for private equity in a portfolio is diversification, the ability to provide outsized returns to listed equities. I think Claire probably covered a lot of the main points there, but its ability to provide returns, especially during periods of drawdowns, is one major point for private equity. And that's really embedded in the fact that it invests in different sectors to what's available on listed markets. Private equity companies, a lot of the time, they're looking to be disruptive to what's currently available in the economy, as well as showing more opportunities on the healthcare and tech side as well. Whereas with listed markets, you find that there's a lot more concentration around, especially in Australia, the ASX, a lot of mining, financials, etc. So having the ability to access those sectors, as well as the ability to provide returns during periods of significant drawdowns, such as the GFC, for example, where we saw an outperformance of around 8%, is a pretty powerful thing from a diversification perspective.
Definitely. It's a very vast field though. So what sectors does Schroders specifically focus on?
Yeah, so I guess I can take that one. As both Claire and I touched on before, mainly healthcare. That's a major part of our DNA. We've been investing in private equity for over 25 years at this stage, with the
Yep.
majority of that being in healthcare. But we also like to target technology as well. So that will be mission critical technology. So you can think about that as like SaaS businesses, enterprise resource planning, accounting software, a lot of these tech businesses that are critical for BAU. Which means that they also are less cyclical. So when we do see a downturn in the economy, these companies are still critical to a business running and therefore are still able to generate revenue. So the combination of that and healthcare, which make up probably about 50 to 60% of what we do in PE, allow us to provide that more non-cyclical return that we really like in a portfolio.
Yeah. Okay, awesome. So there are concerns that private equity firms sometimes lack transparency in how they value the businesses, sometimes making them seem more valuable than they are. How is Schroders addressing this issue?
Yeah, I'll jump in on that one. So I think the difference with private equity and listed markets is once you're in the tent for private equity, you actually get a lot more information than you do for listed companies because you think there's obviously insider trading concerns with listed companies. So as soon as they have information, they have to make an orderly market announcement to everyone at the same time, so everyone gets access to the same information, and to ensure an orderly market trading for that company. For private equity, there's no insider trading because there's no listed. So what we find is that actually, particularly any company that goes into our semi-liquid fund, because we have to strike a monthly NAV, we get updated financials from that company every single month. So we have usually an observer seat on the board. So we get updated financials every month. So I'd say we get more information than you would for a listed company when you have to wait for quarterly earnings or semi-annual updates or annual financial reports. And we use that information. So every month we take updated financials for the company and feed it into our valuation model. And then we look at listed businesses as a proxy for what price someone might pay for that company. So the hard part is, I guess I always say, a good analogy is if you want to sell your home and you're in a densely populated suburb and you have a 3-bedroom, 2-bathroom home. What we do every month is we're looking at what all the 3-bedroom, 2-bathroom houses sold for or traded at, because we look at listed markets. But until you put your particular house up for auction and maybe it's got nicer fit outs or whatever it may be, there might be a little surprise on the upside or the downside. But so our valuation process is very robust. It's very formulaic. As I said, every month we're getting updated financial company information. So actually it's updated pretty much every single month. And then we're looking at those listed companies as a proxy for what someone will pay. So we try to be quite transparent. Whenever we send out updates, we often show what the portfolio as a whole, what its last 12 months sales has been, what EBITDA it's earning, but we can't usually show company by company because that can be confidential information.
Yes, of course.
But rest assured, we have a lot of information that goes into our monthly valuation process.
Yeah. Awesome. Claire, I'll stay with you. Can you tell us about a successful business you've invested in?
Yeah, sure. We've touched a bit on healthcare, so I'll stick to that same sector. And this is a good example because I think it's what we love to do in private equity. So 60 to 70% of the companies we buy are previously family-owned or founder-led businesses. And what we like to do is come in, keep that founder or family to have skin in the game. So our typical capital structure will be, we'll buy 60% of the company, they retain 40%. And then we enter a 3 to 5 year plan to basically buy them out at the end. So it helps with intergenerational issues or transition issues. So in this case, a UK company called Essential Pharma, the founder set up the business and owned it for many decades. So I think sometimes people as well conflate small with risky, but actually often these companies have been around for a really long time, very well regarded in their space. So this was a company that just focused on the UK, waited until drugs rolled off the patent period, and then they would produce those drugs. So quite a strong cash flow business, quite complex in what it did. So we, alongside the manager we invested with, effectively put in a transition plan so to phase the founder out and replace them with a new C-suite of executives in that healthcare space. Also helped them expand into continental Europe and add rare diseases to their product line. So we internationalized them, we added products to their product suite, and then we sort of grew through that next phase of governance, where now they're more attractive for a bigger range of buyers because it's no longer a sort of family-owned business.
Yeah.
It's an institutional quality asset. So that's all gone according to plan. We're about to exit that company and should make quite a nice multiple on what we initially paid for the company. So that should be exited within the next couple of months.
Yeah, I'm just going to backtrack. How did you get to the 60-40 number? So 60% ownership.
So yeah, that's a typical what you want to do for your typical first round buyout. And if you think about it, so that founder then gets 40% of the company on that day.
Yeah.
We normally underwrite and want to at least double, if not triple, the size of that business. So then if we do that in a 3 to 5 year period, even if we just double it, they get back then 80% of what they paid. So they can, what we always say is they can make more money in that 5 year period than they've made in the entire 20 years prior they've had running the business. So it's enough that we've got strong equity and we can make a really good return on the company, but enough that the founder still has enough equity that they're really going to get rich off that second 5 year period. And we always say, follow the money. Alignment of interest is very important in private equity. So at the end of that period, then we all sell out and we have it at a big auction process. And also when we're buying in, because they're retaining 40% of the stake in the company, the entry price isn't quite as important. So we bought into this company in like mid-single digit multiple of earnings, which is really low, especially in healthcare. But then we're all really incentivized, and then we want to sell it off at a competitive auction process at the end, and hopefully everyone, including the investors in our fund, get rich off it.
Yes, that makes sense. Awesome. Eric, could you walk us through a company in your portfolio that you've been watching closely in 2025?
Yeah, for sure. I think probably one of the most exciting stories in the portfolio at the moment is Scale AI. I think when you think about a gold rush, a lot of people say you make more money selling the picks and shovels than you do actually mining for gold. I think the AI rush may prove similar in that sense. Who knows? Like, it's definitely a new frontier and it takes a while for us to figure out where things will land. But Scale AI, the way that the business generates revenue is they'll actually look at creating large language models for businesses independently. So you think about Schroders, for example, we could use we have a large language model similar to ChatGPT that is specific to Schroders, but Scale AI will come in and they'll assist with all of the data labeling and annotation. So what that means is they'll be able to take a large data set and they'll be able to give it meaning. So they'll be able to go, okay, this image is saying this, and put that context behind it in your large language model. This video is saying this, and put text behind it. And this large text block is saying this, and put meaning behind it. So that when you then speak to it, you're able to actually get it to summarize these large quantities of data. So they already have clients such as OpenAI, NVIDIA, Microsoft. All of these big tech companies are using Scale AI to build the kind of behind the scenes infrastructure that allows their models to understand the data. So it's not necessarily the consumer facing part, it's the part behind that is doing all of the tinkering to make sure that the large language model is able to use that data in a meaningful sense. So I think it's a very nascent company. So 2025 might not be the year that it goes crazy. It might be 2026, 2027, but it's definitely something that I'll continue to watch closely because that's something we're really excited about.
Awesome. Very interesting. Well, thank you guys once again for coming on today. This has been a very informative video. Where can people find more about you both and Schroders?
Maybe if you just Google Schroders Specialist Private Equity Fund, you'll see resources, there's videos if you haven't had enough of Eric and I already, brochures, information on the fund and strategy. So I'd recommend Googling that. It's probably schroders.com/, but I'd say just use Google.
Awesome. Thanks for that, guys. Appreciate it.
All right. Thanks, Brad.
Thanks, Brad.